So, good morning, everyone. Beautiful Sunday morning. I'm in Florida. Patrick, you're still in Los Angeles.
I
Um,
am.
it is time to do the Bet Out of Debt show. Today, we're going to talk about the Fang stocks are reporting next week. So, it's a big reporting season. Earnings season has kicked off again. As we know, earnings season kicks off 3, 4 times a year. I had to count it out, Patrick. And then we're going to
hmm
go into some real good detail about how do you pick a growth stock. Oftentimes people talk about I'm not familiar with investing. I pick losers. I don't know how to pick a stock to increase my chances of making money. So Patrick and we're going to show you that today. So hold on, let's start the show. All right, Mr. Doherty, let's get into it. Let's talk about Fang. Do you want to go into Fang first because it is the reporting season and
Yes.
it is that time of the year where stock prices, volatility is elevated. So there's a lot of options trading going on right now, as well as a lot of activity in buying investment stocks and trading investment stocks. So should we start out with Fang and talk
Let's start off
about,
with Fang.
yeah, let's talk.
Indeed.
Now let's explain what is Fang, Patrick.
Fang. Okay, this is an acronym that uh, Jim Cramer on one of his shows introduced, and Fang stands for F for Facebook, A for Amazon, N as in November for Netflix, and G for golf for Google, which is alphabet as well.
Correct. So the FANG stocks are just a very popular set of tech growth stocks. And so, can I share what's reported next week? Let me
Yes.
share that reporting structure. Let me see what I can do here. Let me hit this, Patrick. See if I can get my screen going here. Let's see. Okay, so what I'm using is TD Ameritrade, and basically, if you go and look at some of our past videos, I'll show you exactly how to do this so that you can see the upcoming reporting schedule for any stock. So let's take a quick look here at what's coming up on Monday. So on Monday, look what we have reporting, Patrick.
hmm
Facebook, the F in Fang. And so Facebook is a stock that we talked about a bit, an episode or so ago. I am invested in Facebook. It's a great opportunity to buy for those who believe in the thesis that we talked about. I think it was a week or two ago, Patrick. So,
Yes, it was.
yeah, so Facebook is reporting. And then let's look at the next day on Tuesday. Okay, so on Tuesday next week, check it out, Patrick. We have Microsoft, which is not a FANG stock, but should be a FANG stock. But we do have Google reporting,
Yes.
Visa, and AMD, and Twitter. Those are big technical, well followed stocks. On Wednesday, here's a FANG stock, Apple is reporting. And then on Thursday, to wrap up the FANG stocks, Amazon is reporting. So it's going to be a big week for Fang next week. So there's going to be a lot of options trading, a lot of elevated option prices, stock prices. So what do you think about that, Patrick?
I think obviously guidance is very important, and if many of these large companies, which I expect them to deliver really good guidance, it would be a time for the S&P to continue to make its all-time high. However, if some of these should disappoint, um, then it's going to make for quite a bit of volatility. And if you're an options trader, that's always a good thing because then you can get to if you're a seller of options, you get to collect very attractive premium prices.
Correct. And prior to coming on live, we were talking about a trade you could possibly do based on all of this option activity, maybe sell a put on. Do you remember what we were talking about, Patrick?
I think we were talking about Adobe.
No, not Adobe. There was a different trade that we were talking about. I wanted to share that, but I can't find that trade. Was it Alta? What trade were
It was
we?
okay. There was Ulta Beauty
Yeah, but there was a different trade that I wanted to specifically
at
show.
T-Mobile.
Nah, we'll get back
Okay.
to it. But there was a
Okay.
trade that I wanted to share. I can't find it now, but in any event, let's go into how do you pick a growth stock. I'll think about that trade. I really wanted to show our audience, how do you make money off of earnings. I can't find the trade now, but we'll go into how do you pick a growth stock. That is the main theme for today. So
Hmm.
let's kind of go over some of the best practices of picking a growth stock to make big money. So, Patrick, you know how I feel about this, and you know what I do, number one, on bar chart. And what is that, Mr. Doherty?
You like to see the fundamentals of a company.
I do. And I start out with the technical analysis on a company. And which
Yes.
technical analysis do we use? Without leading you too much, what technical analysis do we use, Patrick?
We use two actually. We use the Bollinger Band to see when to buy, but we also use the 200-day moving average.
Exactly. So the Bollinger Band is our entry and exit point, but to pick a growth stock, we typically use the 200-day moving average. And so let's get into that. What are your faves, Patrick? And can you show how we use the 200-day moving average, the exponential 200-day moving average on your screen, please?
Yes. So some of my favorite stocks, I'll pick. I'll choose. I'll show two of them. One of them is Nvidia. That's always been my favorite, and one of my recent top dogs is Adobe. I picked up some of that, and it's doing quite well. Um, okay, give me 1 second. Let me see if I could share my screen real quick. Just bear with me. Um, got a little bit of technical delay here. Um, because I seem to be stuck on. Okay, here we go. I apologize to the audience. All right. So I'm going to share a screen right now. Okay, so are you seeing this
Yep.
video?
Yeah. We have you on the screen, my friend. So we're good.
Great. Okay, so as you can see, over a 5-year period, Nvidia has more or less stayed above the 200-day moving average. And the 200-day moving average is pointing upwards.
What
The
which
200-day moving.
which line specifically, just so that we're clear, is the exponential 200-day moving average, and
Okay,
how is the exponential 200-day moving average calculated? What does that mean?
okay, so we're looking at the red line here is the 200-day exponential moving average. And it's a derivative of the simple moving average, which is the average of the last 200 days of trading. However, the exponential moving average puts a higher weight on the recent activity in the stock so that it smooths out any distortion from uh, outliers, say. So it tends to be a more accurate reading, a more reliable technical indicator than the simple moving average for that purpose, for that reason. And right now, NVIDIA is trading at a much higher than the 200-day moving average. And NVIDIA is the one in the blue here. The red is the 200-day moving average. And this is indeed a very healthy chart. And then just for extra comparison, if you want to throw in the S&P, the S&P is kind of down below here. I can't really read it too well, but it's beating the S&P. That's the main thing. As long as it beats the S&P 500 over a consistent period of time, it's above the 200-day moving average. So this light blue line is the S&P, so that's way down here. Right here is the 200-day moving average, and this is the NVIDIA right here. So this is clearly a growth stock.
So Patrick, so your metric is the 200-day moving average. I mean, my metric is the 200-day moving average. Your metric is the S&P 500. I think it's really important for people to know and understand that. You know what I mean?
Yes.
So do you put more weight on the 200-day moving average or the S&P 500? Because I think you put more weight on beating the S&P 500. I put more weight on beating the 200-day moving average, and neither one is wrong. It's a preference, right?
Well, I guess I would look at both kind of equally. Probably, I would yes, I would say maybe the 200-day moving average a little bit more because especially if it's an upward sloping 200-day moving average. But the reason why I throw in the S&P 500 as an important indicator is that as I said, many times, and I'll say it again, that most, if not all, fund managers over a long period of time do not beat the S&P 500.
Yeah, correct. So,
Not only that,
yeah.
if I may finish this thought, is that the beta of the growth stocks tend to be higher than one, and I think Nvidia is about 140. One is the S&P 500. So any stock that has a higher beta than one will generally be a growth stock as long as it's consistently above the 200-day moving average.
Gotcha. So let me show you what I do. So
Okay, I'll stop sharing.
yeah, let me show you what I do, because I
Okay.
think it's important to and let me go here. Let me sorry, I was muted. Sorry, Patrick, I was muted there.
Yeah.
To start, I go to barchart.com
Mm-hmm.
and I click study, and then you put in moving average or move, and then you select this moving average right here, moving average exponential, which will give you the 200-day moving average. And it's important that when you select that you change the period to 200-day. I think the default period is 50. You have to
Yes.
change that to 200-day and put apply. And then once you get that, you get this beautiful red line here. And so
Yes.
the whole goal is on using Barchartcom. The whole goal is what Patrick just explained. You really want a stock that stays above that line over a 5-year period. So let's look at something like Apple.
Hmm.
So if one were to say, hey, Troy, you should invest in Apple, first thing I'm going to do is pull the chart and look at the exponential, how it charts compared to the 200-day exponential moving average. And I would do that over a 5-year period. So I would click on 5, and all of this is free on barchart.com. There's my
Indeed.
there's my exponential 200-day moving average, the red line. And so here is my stock price. And you can see over a 2-year period that Apple consistently stays above the 200-day moving average. This tells me that this is an investable growth stock. I personally do not plot against the S&P 500. If it stays above the exponential 200-day moving average, that's good enough for me to say this stock is investable. And so you could just do that with any stock. Like, let's go Nike. You know how kids love Nike tennis shoes.
Hmm.
Over a 5-year period, right there, you will look at it and look at Nike stays. The price of this stock, which is represented by this squiggly, is consistently above the exponential 200-day moving average. So what does that tell you, Patrick? That no matter what, as this stock goes up and down in price, long term, you're going to win because the stock has a trajectory that's consistently growing. That's what the exponential 200-day moving average does.
And the
And
200-day moving average in this case is also upward sloping.
yeah, and that's important as well. So even looking at Nike, this stock here, I'll blow this up a bit. Let's see. Let's go over a 10-year period if you want to even get even better. So you can go over a 10-year period going back to 2012 if I need to blow that up so that you can see this on a cell phone. So going back 2012, you can see that Nike has consistently performed, the stock price has consistently performed above the 200-day moving average. And so it's way up here. And the further the gap between the 200-day moving average and the price of the stock, that's just shows excellent performance. So that's the 5-year. And let's look over the last 6 months. So over the last 6 months for the exponential 200-day moving average, and this is a daily chart. When you're looking at a 5-year chart or a 10-year chart, daily is just 2-minute data points. So it goes to a weekly chart. So once you come in within a year, the frequency turns to a daily chart. And so on a daily chart, plotting the 200-day moving average daily, you can still see that Nike is consistently above the exponential 200-day moving average. So Nike is a very investable stock. Another thing that you would notice here in looking at this is that every time Nike has come down in price, there's been great opportunities to buy when it touches the exponential the 200-day moving average. So case in point, this is a 9-month period. So over a daily chart, when Nike touched here, and this was around April the 19th, April the 20th, right here, that was a great time to buy because Nike shot back up, and then it touched again here, June the 18th, and then boom, it shot back up. So for traders, they look for opportunities to buy low, sell high, right? But even
Yes.
if you do not sell, you just say, I'm just going to keep this stock and invest a long-term investment, which would be 5-year or more. You're still going to make money. But then you had another entry opportunity here on September the 30th. It touched the 200-day again. So traders, people looking for a quick buck, buy low, sell high, sell within 2 or 3 months, put up 10 or 15 G's, 1 G, whatever you can afford to put up. They will buy on these dips and sell on these upward swings. For us long-term investors who do not do that as much, I do it some, then you just hold on because you know over a period of time, Nike is going to continue to go up. So how would you know that? I could look at Nike 5 years ago. Well, let's look at Nike 1 year ago, and you can put the price right here. So you can look at 10/26/2020, and you can see what Nike traded at. Nike traded, and if you go to the far right over there, let's see if I can blow this up a bit, Patrick, so that this can be seen. It's hard to see it, but if you look at the far right, you can see Nike. I think my picture's in the way, actually. So let me see if I can move myself over a little bit. Yeah, so let's go back over, and then let's try it now. So if I go here to October 2020, Nike was $126 a share. Over to the far right, you can see that. And now, like over here, you can see that. Now Nike is $146 a share. Not monumental, but you're still making money. You still did not lose money. And that's the point.
You did not.
You did not. The point is to invest and make more money than the bank. That is the whole point. So that proves the fact. And then let's look at a 5-year period. Over a 5-year period, going back to 2016, I can go and look right here. And if you look at the far right, on the far right, Nike was on 11/7, that says 11/7/2016. Nike was approximately $51.24 a share 5 years ago. Now it's trading at $163 a share, 3 times higher. So if you put up $1,000 there, and you have $3,000 now, $10,000, $30,000, $100,000, $300,000. You get the point. $515. So much better than a bank, but a very easy way to show if you have a growth stock or not. So Patrick, can I show you an example of a non-growth stock, maybe?
Yes.
All right, let me show you an example of a non-growth stock. Here's AT&T. AT&T. Check AT&T out. Let's look at AT&T over a 5-year period. So here is the exponential 200-day moving average. One is sloping down. That's not good, Patrick. You point that out quite a bit. You really point that. So it's sloping down, which is not good. You always read charts for people new to the charts from left to right, like you read a book. And look at the price of AT&T. It was up, and let's look back in the past. We're looking at 2016, right? It was up, and then look at the stock. It gets below the 200-day. It mostly stays below. It goes above, but then it's back, and it's below the 200-day. What does that mean? In 2016, Nike, I'm sorry, I said Nike, but AT&T stock was trading, if you look to the right, at $36.57 a share. If you held that stock 5 years later, you lost money. It's at $25.49 per share. So that's why I really like the exponential 200-day moving average. It clearly shows you any stock. So if someone were to say, hey, what about this particular company? What about Publix? What about Kroger? What about a particular company? You could just put it in here and plot it and see what it looks like. I mean, you could look at Visa. It's pretty popular. You could put in Visa and boom. You could just look at a 5-year period and look at that. Patrick, is that investable? I'm running the cursor over the exponential 200-day moving average here, and then here's the stock price here, and it's consistently above. So as this thing has wild swings, the stock price of Visa, to buy, because Visa is essentially on sale because its long-term trajectory based on the exponential 200-day moving average is going up, it's growing. And look at the direction of the exponential 200-day moving average. It's sloping up. and not down from left to right. So that
Right.
is a really good thing. So yeah, Patrick, that's what that's what I use to pick a growth stock. Yeah, that's what I use. So I just wanted to share that with the audience. I want to reiterate that it all starts with picking the right type of stocks and stocks that have history. Let me show you something else, Patrick. Even with Visa 5 year, let me go back 10 years. It doesn't show 10 years up here, but I was going to show a 10-year period. Maybe Apple. Apple is such a great company. Maybe I can show Apple over a 10-year period.
Google
Look at
as
that.
well.
Look at Apple over a 10-year period, consistently above. Now look at the frequency. The frequency is monthly. Let me blow that up because we're over a 10-year period. This frequency automatically turns to monthly on Barchartcom. But, it's still consistently above the 200-day moving average based on a monthly period. And I don't think Google has been out 10 years, Patrick. So I don't think there's a chart on Google. But let me pull Google.
Or Amazon. Amazon. How about Amazon?
Yeah, let me put Google over a 5-year period, and boom, look at Google. It's great. And look at the great buying opportunities. Frequency is weekly on a 5-year period, but then I can go within 9 months. If I go within 9 months, this goes daily automatically, but you can see very investable. What was that
Yes,
one?
indeed.
And then you say Amazon.
Amazon's another good one. Yeah,
let's check
that's
it
part
out.
that's another Fang stock.
Yeah, that's why. Oh, look at Amazon. Amazon's been on a 9-month period. It's been really bouncing off the 200-day moving average, right? And breaking the 200-day moving average, but mostly consistently staying above over a 9-month period. Let's look at over a 5-year period, though. That's a good stock to invest in. It's consistently above the 200-day moving average. It's very volatile, but it's consistently above. So again, that's I can't repeat that enough, Patrick. So I'm back,
Yeah.
Patrick. So that's how you, most investors pick their growth stocks. So what other tools do you use, Patrick, to go in further detail? If we're just talking from a technical and fundamental perspective, I'm going to leave fundamentals out for now. I'm just going to go technical for now. So what other tools, if you want to use proprietary paid tools to pick growth stocks and go even deeper?
Well, there's a tool that I've subscribed to called MarketSmith with Investors Business Daily, and essentially it
Hold on for a second, Patrick. Hold on for 1 second. Miss Jams has a question, and I really want to be respectful of our audience and putting things in the chat. Miss Jams asks, Mr. Patrick, which codes are you using for the S&P 500?
Okay, and I think I responded. Unfortunately, my name on YouTube is Trini NY, and I hope that might cause a little bit of confusion. I apologize.
So
to
is
Mr. Jam.
that you right there?
That is, and I apologize for that.
Okay, so you're
Confusion, Mr. Jams.
using the GSPC.
Yeah, that's the ticker symbol that is on Yahoo Finance. But you can also use the SPY ETF, which is very simple to memorize.
Okay. Yep.
And
Yep.
it's it tracks the S&P 500 very closely. It may slightly underperform it due to the low management fee, and I mean very, very low, but it is one of the most efficient ways of tracking the S&P is the SPY. Or if you want to memorize the ticker symbol for Yahoo Finance, it is GSPC, Golf Sierra Papa Charlie.
All right, Patrick. All right, so that's how we pick a growth stock for those who, need a refresher on that. let's go into further detail, paid tools to go even deeper if that wasn't enough for you already. So, what do you use, Patrick? You're using proprietary tools that I do not use. I only use free tools like Barchartcom. So go ahead and can you show us what you're using?
Yeah, I use something called MarketSmith to also help analyze various stocks. MarketSmith is a stock screener, and let me briefly share the screen, and then give me 1 second here. So, right here, what I would do is I type in a ticker symbol that I might be interested in, so let's say NVIDIA, and then I just click on this, and it will give me some of the fundamental analyses, such as the EPS growth here, and it'll give me the technical analysis as well, and it will tell me what industry that it's in. But I want to get into that a little bit later. I'll just introduce it right now because it's based on a proprietary model that William O'Neill has come up with.
Yeah,
And
you really like this MarketSmith thing. I mean,
yes,
and it costs a lot of money for MarketSmith. It's not cheap. Why do you
it's not
like it?
cheap.
So who is this William O'Neill guy, and what makes him so important?
Okay, so let me share the screen, and then I'll just kind of talk about him ad nauseum here.
Yeah,
One
I
second.
didn't know this William O'Neill guy, and I've been around for a while, so it's very
Okay,
interesting.
so if, can you see
Yes,
the yeah?
yes.
And this is again by Investopedia. I highly recommend that as one of the leading sources of investment education, and it's free. So William J. O'Neill. Uh, who is William J. O'Neill? William J. O'Neill is a noted investor, stockbroker, and author. He is known for being one of the first investors to incorporate computers into his research and investment decision making process. Mr. O'Neill is also the founder of the influential investment publication Investors Business Daily.
Ah, got it,
It,
got it.
his claim to fame also, he's published highly acclaimed books, How to Make Money in Stocks and 24 Essential Lessons for Investment Success. So he's a wealth of knowledge, and he even at the age of I think around at 88 years old, 87 years old, born in 1933, he's still at it. He's still um, working in the investment industry to some degree. So he, after starting a career as a stockbroker in 1958, and while at Harvard Business School, Mr. O'Neill invented the Can Slim strategy, a bullish formula for determining which stocks were likely to grow. And for all those who know right now, Investors Business Daily was acquired by News Corp, and it's Dow Jones Industrial, or sorry, it's Dow Jones Component, which owns Barron's, the Wall Street Journal, now has Investors Business Daily. And yes, he invented this CanSlim technology while at Harvard Business School. And this is a bullish formula for determining which stocks are likely to grow and become the top performing, and he became the top performing broker at a firm called Hayden and Stone.
Never heard of it.
But that was way back when. It's
Yeah.
probably merged into another brokerage firm. through the series of mergers and acquisitions and consolidations through the industry. He bought a seat on the New York Stock Exchange when he was only 30 years old, becoming at the time the youngest person ever to hold a seat on the exchange. And then in 1963, he founded William O'Neill and Company, a firm that developed the first computerized daily securities database and sold its research to institutional investors, tracking more than 70,000 companies worldwide. And then in 1984, he launched Investors Business Daily. Back then, it was called Investors Daily. And now, Investors Business Daily has a circulation of over 100,000, or is that no, looks like 1 million rather, users. And its website attracts 2.9 million visitors a month. And again, it was purchased by News Corp, which owns the Wall Street Journal.
Yeah, I remember Investor Business Daily way back in the day, Patrick. Even like 1990.
Now,
It's it's been
I
around for a
remember
long time.
I remember when it was called just Investors Daily,
Yeah.
and I remember it on the East Coast, um, and it was I remember it way back when I was in high school.
Yeah, for sure. So, William, was it William O'Neill?
Yes, William J. O'Neill.
So, what is, all right, so William O'Neill comes out with Investor Business Daily. Uh,
Yes.
and so, what's the importance? What's the connection with what you are about to show us?
Okay, so Investors Business Daily uses, or what William J. O'Neill uses, is a model called Can Slim. And I'll start sharing that screen.
So, you're going to go into Can Slim and show what that is? Or what do you,
Yes,
okay.
I am.
All
I
right.
am. And I'll start sharing that screen.
Okay, perfect. Okay. Can Slim. I wonder how he came up with that name.
And I'll show you in a moment. So, this is another article here by James Chen. And again, it's through Investopedia. It's a great free site for education and market stuff. But anyways, CanSlim. What is CanSlim? It is a formula created by Investors Business Daily William O'Neill um, for a system for selecting growth stocks using a combination of fundamental and technical analysis techniques. Now, understanding CanSlim. CanSlim, also referred to as CanSlim or CanSlim, identifies a process that investors can use to pick stocks poised to grow faster than average. Each letter in the acronym stands for a key factor to look for when purchasing shares in a company. The seven criteria that compromise CanSlim are as follows. So, C, current quarterly earnings per share has increased sharply from the same quarter's earnings reported in the prior year. Generally, investors using CanSlim want EPS growth of over 20%, but of course, higher higher the better. So that's the C in CanSlim. A, annual earnings increases over the last 5 years. Again, annual EPS growth should be ideally in excess of 20% over the last 3 to 5 years. N, new products, management, or new events information that push the company's stock to new highs. This type of headline news can cause short term excitement, propelling a surge of optimism within the market and subsequent price appreciation. And over a long period of time, you can look at Ford, how it's turning around, and how AMD is also turned around and performing nicely, both those two stocks. S. Scarce supply coupled with strong appetite for a stock creates excessive demand and an environment in which share prices can soar. Companies acquiring, i.e., repurchasing their own stock, reduces market supply and can indicate an expectation of increased demand along with insider confidence within the firm. L. Laggard stocks are preferred within the same industry. Use the Relative Strength Index (RSI) as a guide. The RSI is a momentum indicator that measures the magnitude of price changes to determine whether the price of a stock or asset is overbought or oversold. The RSI ranges from 0 to 100. An RSI reading below 0 suggests that the stock is oversold and could be undervalued, creating a buying opportunity bullish. Conversely, an RSI above 70 signifies that a stock could be overbought or overvalued and could be a chance to sell, bearish. I pick stocks that have institutional sponsorship with a few institutions with recent above average performance. For example, this could be a recently public company still supported by a small handful of well known private equity firms. Be cautious of stocks that are over owned by institutions, as you may want to get in before the big money is fully invested. M. Determine market direction by reviewing market averages daily. A market average measures the overall price level of a given market, as defined by specified groups of stocks, such as the Dow Jones Industrial Average, the S&P 500, of course, the Nasdaq and the Nasdaq 100, to name a few, Russell 2000. Canton stocks tend to be overperformers in bull markets. The Canton model is a bullish strategy for fast markets, so it may not be for everyone. So it's an aggressive model for choosing stocks. The idea is to get into high growth stocks before the institutional funds are fully invested. All the elements of canceling could be read as a wish list for fund managers seeking growth. So it's a matter of time until buying demand increases. The catch is that stocks that fit the cancel strategy could be among excuse me, the fastest to drop if the market direction shifts and funds prioritize safe havens. Hell no, to the no, 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 hell to the no. In short, Cancelim is a good fit for experienced investors with higher risk tolerance. These stocks cannot be bought and simply held as much as value is being priced for future growth, meaning that any slowing in the economy trajectory or the market as a whole may result in the stock being punished. So, as you know, CanSlim is a growth stock strategy. So, growth stocks generally um, outperform the S&P 500 when the market is good, and that's why the betas generally tend to be higher
Yeah.
than the S&P 500. But that's a double-edged sword, where the S&P 500 or the markets as a whole may decline. These stocks that fit the cancer model, as well as other growth stocks, will tend to go down lower as a result. But then those could be buying opportunities.
Gotcha. Yeah, and that's why when I was showing the charts earlier, you saw those swings in the stock price, right? But
Hmm.
that 200-day moving average says when you're buying on the dip, you're going to make money. But they are high beta, which means volatility. But typically, the higher the beta, the more you make, the better the growth, but not always. So you saw some high
Hmm.
beta with AT&T going up and down, and it was below the 200-day moving average. So I think that's it, Patrick. Unless you have something else to show, we could wrap her up.
Yes. So I think that's it. So again, the good quality high growth stocks will always outperform the S&P.
Yep, and we could have went into MarketSmith a little, but let's not do MarketSmith today. Can we do the
Yeah.
MarketSmith with the fundamental analysis versus the technical analysis when we do a show on fundamental?
Yes. Yes. I mean, to be in MarketSmith, it's not a necessity. I think I think it's a nice to have tool, but there are a lot of great tools out there. You don't have to spend for a subscription.
Yeah, and I have a way to get a paid tool for free, and maybe we'll do a show on that through your local library.
Yes,
So,
indeed.
yeah, so there's a pretty good paid service through Morningstar. Morningstar has an excellent free site and a paid site as well, a subscription version. But that subscription version costs money, but you can go through your local library and get it for free in most places. And people do not know that. I could literally show our audience how to do so, and it's really powerful. So I use Morningstar a lot to do valuations on companies. So that's more of a fundamental analysis show. Today's show is about technical analysis, looking at the charts, basing how to pick a stock by looking at the charts. That is technical analysis. Fundamental analysis is going into looking at the metrics, the numbers, and also what the community analysts and all of that stuff, all of those
As
people have to
as
say.
well as doing a SWOT analysis.
Yeah, SWOT analysis perfectly describes, fundamental analysis. But for now, we'll just do how to pick a growth stock the easy way, and that is technical analysis using the exponential 200-day moving average. You can plot it against the S&P 500, as well as some of the techniques that we talked about here with this can slim. Can
Cancel them.
Yes. So that's it for us today. Let's just keep it simple. That's it for the Bet Out of That show today. I'm live from the hotel room, grainy in beautiful Orlando, Florida area, Melbourne to be exact. We're here every Sunday morning, 8:15 a.m. Pacific time. If you like the show, give us a thumbs up. If you have any feedback, leave it in the comments. And as always, we'll be here every Sunday at 8:15. We call this show the Bet Out of Debt Show because when you place a trade, it's a nickname for placing a bet. And hopefully it's a winning one that always keeps you out of debt. And as always, keep investing, and we will see you next week. Take care.